Welcome to Suburban West Realtor Association webinar series, bringing you informative sessions on topics essential to your career. Today's session, Introduction to Commercial Real Estate, is being recorded and will be available on Suburban West Realtor Association's website shortly after the completion of the webinar. The content portion of today's program will be approximately 50 minutes. After that, we will offer you, the listener, a chance to ask questions. All participants are currently muted. You can hear the webinar, but no one can hear you. When the time comes, if you wish to ask a question, you will signal us by using the Raise Hand button at the bottom of the participant list on the right-hand side of your screen. You may also ask questions using the chat feature in the bottom right-hand portion of the screen. During the presentation, if you need technical assistance, please dial *0 for an operator. There are differences between commercial and residential property that go way beyond a zoning classification. The basic information that an agent must gather and understand is similar, but the details are quite different. This session will not make you an expert in selling commercial real estate. It will identify some of the essential facets of commercial real estate that many agents miss or misunderstand. Our speaker this morning is Andrew Crawford, a Suburban West Realtor member. Realtor Crawford works with the commercial division of a local real estate firm. Thank you, Andrew. Thank you, Andrew.
Well, good morning. Just want to say thanks for joining us today, and that we are going to utilize some slides here today to give you some information that will probably or hopefully help you see that, as Paula said, goes way beyond zoning classifications between the commercial and the residential real estate. So let's begin here. I'll go to our first slide. Our topics today are what makes real estate commercial or residential, and basically we're going to talk about how to qualify a property. And then the second point there is understanding differences in those residential and commercial real estate. And basically what I'm trying to bring out here is what drives our clients and the type of property that they're looking for. And we'll talk about the types of commercial property that's out there. And then the goals for buyers and sellers of commercial real estate. And that'll be something that I find to be very important to maximize your time and your energies. And then there is an importance of commercial real estate training. And then at the last bullet point there is to better understand Article 11 in the Standards of Practice. Our next slide shows us a definition for commercial property. It states commercial real estate property used for business purposes and is responsible for generating income. And a residential definition would say that the real estate which is property used for a sole purpose of living in. The key word here in the commercial definition is responsible or accountable. It's for producing the income, whether you have your own business in that property or whether you're an investor. That definition is rather simplistic but concise. Commercial real estate transactions are typically more complex than residential transactions, and they usually involve large sums of money and increased liability for both parties. And unlike residential transaction, where the law provides a basic consumer protection for the buyer, the law takes a neutral approach to its treatment of commercial transactions. Courts expect that both parties to commercial real estate transactions are sophisticated enough to understand the contract terms, and therefore they will hold the parties to the terms of any sales or lease agreement, absent of illegality or fraud. And for these reasons, the buyer and seller of commercial real estate should have professional help closing the deal. The intent here is that when you are going into this transaction in commercial real estate, what you'll find is that the buyer or seller aren't as sophisticated as you think, especially if you're doing the local commercial transaction. When you get into ones that are more sophisticated, there's usually a lot of attorneys involved, and that just kind of escalates to a new place. Let's go to the next slide. We're going to understand the differences here. Like we have, if you're listing a residential property, we look towards design, style, maybe the appliance and the amenities, the fireplaces and the bathrooms, and the basement types. In the commercial building, we look for, other than maybe you have fireplaces too there, but we look towards the same kind of things, But in the commercial world, we're looking at the type of building and what the amenities it holds, the accessibility to that building, or accessibility into the building, whether it's ADA compliant, what kind of parking there are, utilities, where are they, and how do they get them there? Do they have certain kinds of electric there? Is there public storm water? Maybe the transportation, is it in an area where people can get to easily? And then there's tenancy terms. If you're an investor and you're coming into a commercial property, you're looking for the terms of the tenancy as who's going to be there, how long they're going to be there, and what type of tenant you have in there. So that's really important in that world. And there's many other things we could go through, but this is the differences. They're the basic differences that you see. Then there's types of commercial property. Our types of commercial property, we would go somewhere. We can see an office. An office could be an office building could be a home in an area that's in a commercial space that has maybe an accountant in it or something. It could be a single building in a small version. But it can be as much as a small professional office. It can be a skyscraper and everything in between. Industrial properties, they range in all variables too. They're like the smaller ones were called flex spaces or R&D properties. And then you move up to the square footages. You can get up to, I've seen buildings 100,000 square feet, maybe even larger. But they can be a lot of variety of that. And then you have the retail stores. That's a whole other, I guess, animal unto itself. What you have there is a retail store has the space. They utilize the space, and that whole scene is changing. And we'll talk about that a little bit later. Then you have the farmland. The farmland is basically an investment property. If someone's going to do that and it's undeveloped, it's raw, it's rural, and what you need there is you'll need to have research on a lot of the amenities, and we're seeing this day from finding a piece of ground until the development starts. It's probably 24 months to 36 months before you're able to do that with getting all the approvals. So then you have multifamily housing buildings, and I would presume that some of you are familiar with maybe a 2 to 4 unit. And when you have those properties, they can be they can go into a place that could be a fourplex, or it can go to an apartment complex. It can become a high rise. There's a lot of variables in that. There's warehouses and garages. When you talk about a warehouse, the amenities that go with that, you might want to be discussing with your client, how big of a space they need, what type of traffic flow they'll have, what type of vehicles goes there, and so there's lots of issues. That garages can be just a place where they have a small garage for storage. And they do warehousing there, but it's not the need is not for big vehicles to get through there. Self-storage facilities are a big one these days. And then I have a category called miscellaneous. And that's the catch-all for everything else. There's hotels, there's medical buildings, there's hospitality buildings. Hospitality buildings could be a bed and breakfast. So as you see, there's many types of commercial property that you need to consider when you classify what someone's looking for or when someone's trying to sell. Sometimes when we go through these things, just as in the residential world, we have language that we understand, but maybe our client doesn't understand. Interestingly enough, I think sometimes when I talk to a 20-year veteran in the commercial world, he'll talk in terms and he'll be throwing a lot of things at me that I have to either go look up or pay more attention to, because what you have is I have a booklet that has about 75 pages of these terms. And so when you talk about a cap rate, which means capitalization rate, I think we would be familiar with that. But a cap rate has they're done in different ways. They're done. It's basically it's an income-producing property, and what we're trying to do is figure out its future income and its value, the return on someone's money. And then we have things like net leases, and there's single, double, triple net, and they have all the things that are included maybe into the rent, and they should be separately priced. And then if someone says I want to put a gross lease out, that could be thrown in there. Escalators, someone will talk about escalators. They're annual increases. And how does that go? Some people do it based upon the GPI, the gross product index, and That can be done that way, or you can have a static one. It goes up so much per year. Then there's CAM charges, common area maintenance, and those common area maintenance things are also charges that need to be separated as far as your insurances. Maybe your common area to be landscaped or snow removal, and the outside maintenance of the building. And there's NOIs and GOIs, which is net or gross operating income. Very important, because someone will say the gross operating income has a certain value, and they base it upon what they're going to buy a property for, and it gives it a certain cap rate. A more savvy buyer will be looking at the net operating income versus what they're going to put out of their pocket. Okay, then you have TIs, what they call tenant improvement allowance, and that might be someone says, I'm going to move into that space, and someone asked, things like, okay, how much money will the landlord allow me per square foot to, rehab this space? And so that could be someone that the landlord's going to provide that money, or they're not going to provide that money, but they'll usually ask you for that. So it's a different language, but it's more familiarity with those terms, like we have same that we have in residential real estate. Now here's the one that's most important. I call this the buyers, the lessees, the sellers, the landlord transaction goals. In commercial real estate, I have found it's really, really important to get together with the client. Like when someone calls on the line and says, I'd like to go see a property, you should have a set of questions that you ask right up front that it helps clarify. Now these are pretty extensive. This is usually when you get them in your office. This is the best time to do this, is if they're really interested in something and you have the opportunity, is to get them to the office and explain some things to them that might be I think critical to maximizing your time and your search. Someone will say, I saw a property downtown and I'd like to rent that. Now, of course, you want to get them there, but we want to find out what the client's priorities are for this transaction. Like, if they're the seller, why are they selling the property? If they're the buyer, obviously, why are they going to buy that property? But some people if they're going to buy it, they're basing it on cash flow. And some people buy it and say, okay, I'm going to buy it today, and it's for a later date that I want to get an appreciation out of this property, and maybe that's my retirement fund. And sometimes they're building a portfolio of properties. These are critical questions. That can be very helpful to you to know, first of all, what type they're going to do, and then how you can continue with those clients. If they're going to put something into a blanket mortgage, that can become critical based upon the fact that you have to measure out what a bank will allow them to do under a blanket mortgage. That's very important to know, because then otherwise, if they say if they're serious and they say they're going to do that, that can be a stumbling block to get to the closing. And then again, the return on investment. They'll want to know what all that stuff's about. There's terms like internal rate of return, which gets very sophisticated, and that's when you probably start talking to a CPA, and they can give you more information on that. But your client, if they're sophisticated enough, will want to know these answers. 1031 exchange, there's time frames to those. Are they liquidating the properties? If you have a seller doing that, it's good to know that, because if they're doing liquidation of properties, you might be able to package something for them, and the package might sell better than if it wasn't packaged. So it's good to know what they own and how they own it. Upgrading property portfolio, you have a buyer who's trying to build the same, so it goes in reverse. There's someone doing a liquidation, there's someone doing an upgrade to a property portfolio. And the consolidation of property type. If someone has an affinity towards industrial properties and they're coming in to look at something in a hall or field, you need to make sure that they understand more about that field, or you want to steer them in the direction of the property type. Blanket mortgage extraction. It's one thing to put your stuff into a blanket mortgage, but then when if they're going to sell a property separately somewhere down the road, if you know that, the extraction becomes much easier, because you have to go through the bank to do that, and the bank has to okay that, and usually there's payoffs in that. So there's issues with that, but they need to know that. I put blanket mortgage in here twice, didn't mean to do that. And then there's tax ramifications, very important. One of the things that goes unseen in a lot of transactions is the tax ramifications over years, how it impacts their depreciation and how they add that into their tax returns. If a person's getting an income, and this is a cash or an income producing property, that can have very large tax ramifications over time. And then obviously the one is if you are talking to a user owner, you want to know what their business is, and then see if you can fit that to the property that they need, whether they're growing or they're downsizing. We went to listing commercial property. A couple of these things that we'll talk about here, the key information of the list of commercial property, we might cover a couple of things twice, but then each one will be a little bit more in depth. When you're listing a commercial property, obviously we're looking for the proper address. It may sound crazy that we would think that we would know that. We would get the public record, it would be on there. Sometimes you'll have a property that the proper address on the public record tells you it's 123 Main Street, but it's known as 234 Main Street for whatever reason. And sometimes the post office has given it a address to deliver the mail to. Same way if you have a building that has multiple units in it. They can have their own address, or they can be separate and be suite numbers and so on and so forth. But you need to know that up front. And then zoning classification and its present use. Most likely when you find the property and you go to the public record, they'll give you a zoning classification, and you'll see how it's used. But you need to make sure and clarify that there hasn't been a change to any zoning or not a zoning overlay. A lot of townships now are looking for along main roads what they call ratables to bring in as commercial users because it has a higher tax base. So you need to know what is the zoning classification and its present use. And the thing that you need to know about the present use is it's not necessarily true that things become grandfathered when they change hands. Sometimes when you release something, it'll be fine. But if you're changing hands from a seller to a buyer, a new buyer, that present use that may not be acceptable to the township. So you need to make sure you know that. And then the inclusion and exclusion. Some of the things that happen there is that there's equipment, like if you're doing an industrial building, there's equipment in there that might be owned or leased, and you need to find out whether that will be in the transaction. Sometimes you'll have like I'll use an example of a car lift. Some of those machines are leased by the present user, and sometimes you can transfer those leases. Now we're in the business of selling real estate, but this can be important to get through to the end of your transaction to know that information anyway. And then if you're working with anybody who's an investor, they'll want to know the current leases, and I know that doing multi-units, you may have seen that before. It says on the contract that the owner will get you the current leases within 5 days. That's an important thing to have. In this case, the current leases, if you're going to list a property, it's important to know about them so you can produce what they call a pro forma for potential clients or potential buyers to come in and purchase that property. Also, security deposits. Oftentimes, they get overlooked because someone hasn't asked about that question, and there'll be maybe $5,000–6,000 sitting somewhere as security deposits should be returned to a tenant when they leave upon the inspection of the property. But we won't pay attention to that, and then we'll get to settlement, and someone will say, what about the security deposits? And now you're at a very awkward moment that says, what do I do about that? Because now it could cost somebody, $5,000 or $6,000. And the lease price, the list price and lease price and the lease purchase, those things, when you're going to list this property, the pricing can be predicated on the leases that go on the property because it could have a cash flow, and also you should need to ask your owner if they would entertain a lease purchase because there's sometimes you'll get a buyer that has the ability to put so much money down, but it won't qualify in the bank, and so if a year or two from now the business is doing well, you need to know how to put one of those together too. And the marketing expenses, that's really important to to see what type of sign you're going to put down, and then who pays for them. There's additional fees for specific services too. Someone may ask you to keep the lawn cut or keep the building clean or get whatever needs there. So you need to make sure you find out who's going to take on those expenses. The type of sign, if it's on a major drag highway, what will happen is someone will say, okay, I'm going to put up a big sign there. Well, first of all, you have to see if it's allowable in the township. You have to probably get a permit because it's not a lawn sign. And then some of those signs can be $600 and $700. So you need to find out, who might pay for that. And a lot of times you probably want your seller to pay for that. And one of the things I don't have on the screen here, but it's about the commission. The commission, that when you put this together, there's many types of contracts that you can put together for the commission, and it can be based upon lots of things. So you have to make sure that you're aware of the different types. There's probably, it's been my experience, there's probably 10 or 12 different types of commercial commission statements, because you're going to include some things that you might not include in a residential environment. So let's move on to the next one. We're going to talk about when you're going to list. Let's talk about the zoning. Zoning is an interesting an area because the zoning and use by right. Our definition on the screen here is it defines the land use or land use categories designated by a municipal or local government laws and that dictate how real property can and cannot be used in certain areas. And the use by right is a use by right permitted in the zoning district and is therefore not subject to special review and approval by a local government. Those things are really important because if you're taking someone to see a property, if they're going to do a use or the zoning or what they want to do isn't zoned, is in that zoning, you might want to let them know that. I mean, it doesn't mean that they couldn't change that or go to get a hearing, but it just extends your time frame, extends the complexity of the transaction. So you just need to recognize that right up front, because the zoning is really a control device for the local government, and what it allows them to do, if there weren't any zoning, the market would be reduced because the land might not be allocated properly. Like when you have there's studies being done all the time on how land should be used and what it's zoned, and that's why you get zoning changes, because maybe the area has changed, maybe different things have been used there, put up there before there were a lot of the zoning ordinances. So that process can just extend your time, or if you go in the right direction, you can let them know, they're informed, and then they have the opportunity to be very streamlined in their purchase or the lease. So I think that's a critical point. A commercial listing contract. What I put this in here for was to show you that, basically the contracts, the Pennsylvania Association of Realtors has put together a very, very good listing contract, and they made them very similar these days to the residential form. So what we're trying to do here is just on this listing contract, there's many of the same categories, but the entity information for the owner is critical when you put it in there. You need to know when you're listing this property if it's an LLC or an LP, or if it's an LP doing business as an LLC. You need to know all those things, and it can become very complicated and very time-consuming later on. So if you right up front, if they say that it's owned by an individual, easy. That's who owns it. But then if you have an entity and you up front find out who that is and you get the articles of incorporation, you will find out who has the authority to sign. Because even the listing contract, when someone says it's an LLC and they're signing for it, I make an assumption, you make an assumption, they are the person who's selling it or have the authority to do that. And it's a pretty embarrassing spot to get down to the end that you're in settlement and that person never had the right to or authority to do that. So it's important to get that information right up front and have it on file, because you can help expedite the transaction. And on the commercial listing contract, there's a leasing fee area. It's included in that broker fee section. And it's important to, if you have an owner who's selling a property that's vacant, you should ask the question, would you allow me to get a tenant for that space? And they might tell you it's a good, they don't want to be involved with it, they don't want to deal with it, and they're just trying to be done with the property. But if they say, well, that might not be a bad idea, then you have to figure what your leasing fee will be. And if you look at the document real close, In the document, it talks about renewals, expansions, and extensions. You need to discuss that with your client, because those things become things down the road. If there's renewals in a commercial world, in a renewal, you should get a commission for that if you are involved in getting that next renewal. If there's a 5-year option and they come to that place, that's important to have that. But if it's not in the listing contract, it might be out of your right to do anything about that. So these are important things you should do, and completing this form, you should be familiar. This should be familiar to you anyway, because you're doing it already in the residential world. Buying or leasing commercial property. Okay, this is if you're going to be a tenant rep or a buyer rep, and you have someone coming to the property. To maximize your energy here and your time, the type of property required, just as we talked about earlier, these are important questions to ask them so that you know what type they're looking for, exactly the space they're looking for, and a lot of times they won't know that. They'll come to you and they'll say that the property that's required, I want a space, you know, it could be in Westchester, and it could be in a location they want 1,000 square foot. Well, sometimes you got to sit with them. They say 1,000 square foot. If it's going to be a medical office, sometimes there's traffic spaces, there's traffic lanes through the buildings. That's what they call them to get to the office, and how that lays out. And they may need somewhere about 1,500 square feet. So it's good to know what they're actually going to be doing there, and what they think they need, and then you can help them out with some variables. There's always about a 30% space that's I call it there's usable area, and then there's leasable area, and some of it needs to be investigated so that you can instruct your client and then help them to understand that better. Again, if it's an investor or user owner, their goals will be totally different, and so you need to know if they're an investor, they're looking for you to prove to them that if it was rented, this is a good investment for them, and that you could get it rented for them. And again, about under what name will the property be purchased or leased, and that's important to have that, because if there's LLCs involved, again, you need to have all that information. If they're a new LLC, a bank will not be as amiable to lend them money. They'll have a situation that says a new LLC won't have this, so they'll need to put up some collateral of their own, and they'll probably have to have a document that states what that is, and usually will go against their house, or they'd have to take it out in their own name. And then a time frame that's required. If they tell you that they need to be in a month, if the space is exactly what they want, that's a good possibility. But a lot of times they'll tell you they're 3 months out, whatever, and you need to then go back to your seller and tell them how that works, and what would they require for them to hold that property to get to that place. We talked about the intended use of the property, and then you also should know exactly what is their budget. What are they coming to the table with? Are they looking to get a space, and they have a budget they can't afford that space, so you need to direct them in that type of scenario. And also, if they're bringing in an existing business and they're going to lease, the landlord will be. It'll be very important to them to know their success and how long they've been in business. They'll want to see financials. They'll want to see all those things. If it's a startup business, I always instruct a client to go to or have a business plan. And I found this out in a really unusual way, but there are universities that are in our area will help you put together a business plan. And I mean, they're going to use students as they get some experience, but getting a business plan is really important. And so that would be a real advantage for you to have all that information when you're going to take somebody to see a property or instruct them on how to do that the best. This is a topic that when I first got into the commercial world, I had heard for years about the letter of intent. The letter of intent was like, why do you do that? Because it's like, it's common, it's common practice in some areas, in some disciplines. So I always heard you shouldn't do that, and why waste your time? But it's a common practice in commercial real estate to utilize the letter of intent. And it's usually done to nail down a baseline before issuing an official agreement of sale. And so, and depending upon the sophistication of the transaction, a letter of intent conveys to the seller that the buyer is serious or willing to be in the transaction. There's orderly collection of necessary terms. The agreement is subject to a written contract. And all these things, there's a very interesting thing that the primary utility for a letter of intent is to set the binding ground rules of negotiation. One of the things that causes a problem is in a letter of intent, the parties fail to accept the practical situation that some of the provisions must be static or concrete and possibly contractually binding, and the other provisions must be fluid, perhaps vague, and non-binding. And that's the problem with the letter of intent. It's not written so people will understand it. Something that might be binding would be if someone sets a price and a date. They might say these are the dates, and that has to be pretty concrete. Something that might be more non-binding or be fluid, it would be if someone's going to buy a property and then assign it to another party. That would be if I'm a company and I'm purchasing a property and I might put a franchisee in it. Those things would all be changed down the road. So they talk about that, and that's how letter of intent starts. Letter of intent can have, I've seen it as long as a year. They can be subject to all different conditions that need to work. Now, you need to have that letter of intent because you might be working with a big client who that's how they do their business, and once they get to a certain place, they'll do the commercial agreement of sale. I always ask them to put a time frame to that commercial agreement of sale, because then you have the written contract and all the binding elements in it. So it's really important to do that. I mean, it's to understand that, I think, more than do that, to understand that in the transaction. The agreement of sale, I want to just do a little comparison here, just so that we can talk about that. The agreement of sale has a residential agreement of sale, for instance, has a seller's assist. On the commercial form, that's not on there. And it doesn't mean that there's not an assist from the seller. It doesn't mean that. And it's not usually in the closing costs. It's usually more about giving them, it could be a private loan, it could be all sorts of things. I mean, it's basically those to get the transaction through. It's not a seller's assist. There's no place for that on that form. The settlement date, there's a settlement date location on the commercial form, but you need to include all the contingency time frames, and sometimes that equals a separate document. The reason I say that is because the settlement date in a residential transaction, I mean, the banks will set up a time, and it's usually between 45 and 60 days they would like to make it happen because that's they can hold the rate. In a settlement time for a commercial agreement of sale, it might be 8 to 10 months away, and the bank will negotiate those rates all along the way. In other words, they're more shopped around in the commercial world, and if you're a seasoned commercial buyer or own commercial property already, they're more favorable rates to you because you have a history on what you can do. And so you have to make sure that you understand what the settlement date might be. A written acceptance, there's one on both of the documents, but you have to make sure that when you put the written acceptance down that it could include some of the letters of intent terms. You make sure that when you put these time frames together, they don't overlap, they don't run too far, so you have to make sure you understand in which direction this is going to go so that the time frames equal everything that you need to happen here. In the same way with a mortgage commitment date. Finance commitment date can say, I have a bank here, and the bank may say, yes, we'll stand behind this person, but the commitment date isn't usually a solid date because it could extend due to all the contingencies that you have in there, because it's just like in the buyer's due diligence inspections that you have on the residential agreement of sale. The buyer's due diligence is also on the commercial agreement of sale, and they have extended the time frames from, I think on the residential it's 15 days, and on the commercial it's 30 days. And what's really critical here is I usually find that the due diligence times are set aside differently, more specifically on there. So you have to be very careful. 30 days sometimes won't do it. There's all reasons they may have to be extended, and because some of them are I'll call them trigger events. If one thing happens, the next thing will happen. So you have to be aware of those things as it goes on. And then there's a broker indemnification clause. It's number 23 on that form. And the reason that that's in there is to say what brokers are involved, because lots of times you'll have in a commercial transaction, there'll be many attorneys involved, and so you have to say, okay, who are the people they will contact? And there could be, like if you're doing a transaction where there is a retailer who comes in, they may have their own representatives, so there may be 3 people involved in that. So you have to really see who gets indemnified in there and who the buyers and sellers know are representing each entity. So that's kind of put in there to indemnify everybody from that. Let's talk a little bit about due diligence. We kind of talked about the time frames. We talked about in each one of these documents, but the due diligence here is real important about the residential transaction. There's some very specific things that get done, and they have that time frame, because I think one of the time frames that might command this is the fact that you have a financial commitment that has a certain date, and they're going to hold a certain rate for that time. The commercial transaction, a due diligence clause, which is number 11, is a real important clause, because it also has time frames. But again, as we talked earlier, these time frames aren't as specific. They might be doing something written down that talks about zoning, use by right, or land soil studies, transportation, traffic studies. You have things that might say if we can prove there's 30,000 cars that go by this corner today or every day, then what we'll do is then we'll do this. So everything one might predicate on another thing. So I find that commercial buyers are looking for much more specific details and terms. And the corrective proposal, a lot of times if we have a home inspection, there'll be certain things stated in there that will have the inspector will say these are safety issues, these are recommended issues. In a commercial transaction, when it's inspected for whatever reason, it might be that they need the ground to perk, or they may need certain specific things done there. There needs to be what's stormwater management going to be there, and so there'll be a corrective proposal letter. And sometimes they come from attorneys, and so you just need to be aware that the due diligence is usually more specific, and sometimes I think a little more. It just complicates the time frame. So you just need to make sure you're aware of those time frames. Marketing a commercial property, very similar to a residential property. The content is like what is it that the property has here? What information is meaningful to your audience? That's kind of what we mean by content. If you qualify your audience, if you're doing an industrial property, how do we market that, and who do we send it to? Who sees that? And you think about if you have an industrial property, it's warehousing, you could send it to big box stores. They do a lot of warehousing these days. What specific terms should we put out there? Is it usable space? Are there CAM fees? Sometimes if you put too much information, you don't get a call. If you put enough information that it piques the interest of everyone, that's good too. But then you have people who are looking and don't want to make the call. They want to, because they've already vetted out their buyer and they know exactly what they want. So sometimes you'll get those calls and they won't be real happy with having to ask you a lot of questions. But also it's important to figure out who you're going to market this property to. And then what venues do you use? Well, is it Trend, LoopNet, CoStar, the SWRA websites? You need to get your property out there where people will see them and be able to make that call to you. But you need to have all the information ready to share with them. So you evaluate your property, and then who needs that type of property? That's where you're going to qualify your audience. So marketing is very similar, but I just think that what drives you to make this transaction is a little bit different than it is in the residential world. Article 11, I wanted to bring that up because in the standards of practice, what it really is it's about is it refers to the competence in specific real estate disciplines. When I started in this part of the business, I thought, well, how different could it be? And as I've been in it for some time, I find that it's pretty different. So I think it's important to understand that. it would be something that if it's not in your client's best interest or yours to work in a discipline that's not your area of expertise. So an example of that might be the transaction requires financial documents to help with the sale, and you're unable to factor in that information to the value of the property or business. You may be out of your area of competence. So it may be good for your clients and in their best interest for you to refer to someone who's trained in those disciplines. And you can, if you have built this relationship with your client and you bring them to another person who has that expertise, I mean, it's not like you can ask for a referral because you have that relationship with them. So that's important to understand. I think that's something that sometimes I think we go very close to the edge on this. So we just need to be aware of that. We have SWRA education. What it provides, and there's if you need a commercial real estate education, there's avenues for that. It's very important to get that education because what happens is commercial real estate agents spend a tremendous amount of time, I think, investigating statistics and things that make for a better idea of what's going on. You get knowledge of the industry, and you may have a specific area that you're involved in, and then in the economy, how that's being impacted. Like if you're looking at certain things, like for instance, I'll just throw a statistic out. Between 202 and Oxford on Route 1 corridor, there's about 250,000 square foot of office space available. And so it's like you need to know that. So when someone says, I'm looking for office space, and you say, okay, where are you looking? Then you have an opportunity then to help them either find the space they're looking for. So it's the knowledge of that, the knowledge of the economy, what's the local market's doing, the awareness of types of commission contracts, because if you're doing, you can do all sorts of commission contracts and how your broker might have a guideline or a standard. So you need to be aware of the types of commission contracts you'd have. And then transaction time awareness, that's really important. I've worked on deals that I got in this business about 7 years ago. And I worked on deals that have taken 3 years. Are they good deals? Certainly, but it takes a lot of time. And then your research capabilities. What are you able to do? Are you a person who has accessibility, or are you able to understand what needs to be done as far as the research for a client? And awareness of tax laws. You don't need to have an expertise in that, but you need to know what's out there. When someone says there's a bankruptcy, well, there's 3 or 4 types that you want to be aware of, just so that you're saying, okay, and if they say I'm in Chapter 7, Chapter 11, Chapter 13, you need to know what that means, or it's important to know some of that information. You don't need to have the specific. That's when we turn it to an attorney or someone that would have the knowledge of that. So I think that's really important to be very educated when you get in the commercial business. And then I want to just conclude some things here. We've been talking about lots of things, probably at a high level, and there's similarities and there's differences. And I just think that there are common daily activities that when you compare these two disciplines. And the differences are significant enough, though, to take serious consideration before making a move to do, if you say, to do one or the other. I think it's good, but when you do both, unless you're very knowledgeable about both entities, I think it'd be important. Because if you're selling a house, you're selling to someone for them to live in, and they love the property, you help them get there. And in contrast, when you have a commercial buyer, they're looking for all the economic aspects of what does this property mean to them? Will it make them money? If they're purchasing the property, will in the future, like, will it have a value? Will it appreciate? If someone buys a large industrial warehouse, it'll be a large industrial warehouse 10, 15 years from now. So, what does the economic trend look like for that area? Will that be a valuable piece of property? Is that the right way to send them? So they're important things to know. So I just want to say that if your perception of commercial real estate says, I like it because the transactions are usually lucrative and require minimal hours, well, I think it's time for you to rethink that perception. It's just like residential real estate. There would be some lucrative transactions in commercial real estate, but the hours are never minimal. And so, whichever discipline you're working in, you recognize it's a great business. It takes a lot of education, a lot of licensing, that knowledge, and it's it's a rewarding vocation here. But the things that are important is that you serve your client well, and that we do our jobs in a fashion that's very, very professional. So I thank you for your time here, and hopefully this is giving you some information that's of value to you.
So thank you, Andrew. Now with the time that we have left, we will take questions from our listeners. If you wish to ask a question, please signal by using the raise hand button, which is found below the participant list on the right-hand side of your screen. When we acknowledge you, your location will be unmuted so we can hear you. We ask that only one person speak at a time, and preferably the person closest to the phone. After the question is asked, your location will be muted while the answer is given. You can also ask your question by typing it in the chat box in the lower right-hand corner of the screen. We'll try to get to as many questions as possible in the time remaining. So you can ask your question by raising hand or by chatting in the box. Well, Andrew, you must have done an excellent job of not seeing any questions. We'll give people just another minute to think about it.
Well, in the meantime, too, Paula, this is Steve. Again, just a quick note that the association, of course, does have a commercial investment marketing exchange that meets the second Friday of every month, and Andrew is a member of that exchange, and there's a few other commercial practitioners who serve, who come to those meetings, and again, they're always willing to share some of their expertise, and again, it's a way also to that they see the market properties amongst one another, and also an education component too. So it's from 8:30 to 10, and we do put notice in our weekly about that, about 2 weeks ahead of when it's coming up, but we also maintain a dedicated email list, so if you are interested in getting added to that email list, you can just communicate to me here at the association, Steve Race, and we can, of course, add you to that list.
Steve, I see we have a question from Patricia Hartel.
Yeah, let me unmute her. Hi, Patricia.
Can you hear me?
We can hear you, so
can.
go ahead with your question.
Okay. My question is, what's the average length of a commercial listing contract? Is there one?
Well, yeah, actually, when you are doing the listing, we always are going to shoot for a year, but once you engage somebody, that doesn't go away. Like it's till completion. So when you get in there and someone says, okay, now you have it up for a year, and say in 10 months from now that you have a contract or a letter of intent that's going to involve a certain amount of time, that'll go all the way through to the end of that.
Okay, so you need to extend your listing contract, obviously.
Well, that's a safe way of doing it. You don't have to, but as long as the transaction is contiguous and from when you start it was within that first year, then you can do that. But I mean, I always attempt to renew the contract because I think it makes sense. So in case something unusual happens, you still have it.
Right. Okay. Thank you.
Okay. All right. Thank you.
Okay, so I saw Rich Shermer had his hand raised, but then he undid it. So, Rich, if you still do have a question, you can either, again, actually use the question box. That's another option, too, down below, either the question or chat box, or, again, you can re-raise your hand. Okay, any additional questions from folks? Again, another quick note too is that as always, as Paul had mentioned earlier, we will be posting a recording of this either later today or in the next day or so. So just be on the lookout for that. So we did get a question. Oh, actually, it was just a thank you that we received. So who was that? I can't see who sent that. Thanks from Carol Luskin. So thank you, Carol, for that.
Appreciate that.
Any additional questions or comments? Again, you can type them in using the questions feature, or again, use your raise hand feature, and we can take you live over the phone.
Okay.
Okay. Well, again, Andrew, thank you so much. And just
Thank
again,
you.
one additional note is that we will be sending out also an evaluation from today. So you should be on the lookout for that in your email. And again, we always appreciate your input into how we do with our webinar series programs. So, Paul, anything else you want to add?
No, I think that was it. We thank you everyone for participating, and certainly if you have other questions, you can put them on the evaluation as well.
Okay, well, thanks again, Andrew, and again, everyone have a great week ahead of you, and we look forward to connecting with you again at a future webinar. Thanks again. Have a great day.
Thank you.